morning. Today is Monday, December the 18th, about a quarter of 6 a.m. PT. And I want to go over a couple of things here that involved getting out of a trade, how to get out of a trade, and why you should bother getting out of a trade. So let's start with the trade. Let me set up something here. It's similar to what I did a few days ago. So let me just go 2-3 days out. And the basic idea behind the trade was I used a short call vertical in SPX because I thought the market was going to go down a little bit, and I just want to do something simple and go this route. So I sold a 47.50 call, and I bought the 47 double 55 call, and that would leave me with a short call vertical. And let's take a quick look at the analysis tab so we have a visual of how this works in terms of profit and loss. And we can see that obviously if we go down, the trade's profitable. The max profit would be the credit received upon sale of the trade. So let's say 170 here. And then the max loss is going to be the difference between the width of the strikes, which would be $5, times 100, which is the multiplier of SPX, $500, minus the credit received. So if we received 170, our max loss is going to be $330. The platform provides these numbers for you. However, you should still have a very, very clear understanding of where those numbers come from and how to derive them if you didn't have the platform providing the numbers for you. All right, so market goes down after I sell it. Time passes, so I have time decay working in my favor with direction working in my favor. This was a 0 DTE trade, by the way. And then I noticed that this call vertical was trading for around 10 cents, and I had sold it at $1.10, not $1.70. So let's see. Let's say we did that. And again, the visual, I'm not going to go through the visual. It's going to look pretty much the same as it did before. You see the difference. This profit line went down from 170 to 110, and the corresponding profit and loss figures were adjusted to that, okay? So I'm going to have a bit less profit and a bit more potential loss as the trade was actually done. So market goes down, time passes, a couple things go my way, a couple of important variables, and then I decide it's time to get out of this trade because it's worth 10 cents. Now, why should I bother getting out when it's a 0 DTE trade? There's very little time left in the day. I want to say there was less than an hour left. I'm not sure. I can find out. But anyway, why not just let it run out? Well, the main reason is, personally, I think it's pretty sloppy because the trade is at a point where it's worth 10 cents. So the most you can make on this moving forward from that point is $10. And the most you can lose from that point is $490. So since I sold it for 110, I've already received, but not realized, almost all of the profit that I can. And what's remaining is very little profit and a lot of potential loss relative to where I initiated the trade and relative to profit and loss available. So now it's mostly this is worth 10 cents when it was worth 10 cents. There's mostly loss I'm dealing with, directional risk, and very little profit. So letting it expire worthless, I think, is a bad idea because it was still close enough that buy orders coming in at the end of the day could have price of SPX, the underlying, blow right through these strikes, and then I would be sitting on maximum loss when I had almost maximum potential gain on the trade. So I'd rather cover it. Now there are a couple things well, there are a few ways to go about this, but think of it this way. If I wanted to get out by doing the opposite of the trade, so since I sold a call vertical, I'd have to buy one. I would effectively be buying one for around 10 cents. My profit at that point would be $100 because that would be 110 I received for selling this minus the 10 cents, $10 it cost me to buy it back. So there's a $100 profit if I do it that way. However, not everyone can do that because of PDT, pattern day trading concerns. If you're stepping on the same strikes by buying and selling in the same day, you might have a problem, which could result in you being benched for 90 days. It's just the way it is. So you don't want to do that. All right, what else can I do? Well, let's say that at the time I was getting out, what if I could have gotten 10 cents for the following? So I modified the buy here, and what I did was rather than getting out of the trade by doing that, buying a 47.50 and selling a 47 double, I went down a strike for each one, and I'd be buying a 47.45, 47.50. And even better, if I could do it for around 10 cents or 10 cents, I could have bought the 40 and sold the 45. And what would that have left me with? Well, it would have left me with a condor, all right? And it might have cost me, let's say that this cost me, the call vertical that I'm buying to get out cost me 10 cents. If I could somehow get that for 10 cents or anywhere close to 10 cents, then I'd have a condor on for a credit, and that would look like the following. All right. Now we can change this, the red zone area, mentally to, this would no longer be a loss because we're not paying 35 cents for this. We'd actually be, if we got 10 cents, it'd be a credit of $1. So in the worst case scenario, had I been able to do that, I'd have a minimum profit no matter what happens of $100. And I'd have the potential profit of maxing out on this condor if prices land between 47.45 and 47.50, because then I'd make max profit on the long call vertical, and I would receive full credit, max profit basically on the short call vertical. So if you can get a free look by setting this up as a condor, or even setting it up as the following, let me do this. And I'm going to sell one more. Then it'd be a butterfly, and you'd still have a credit for doing the whole trade with the possibility of a nice payoff at the apex of the butterfly or the apex of the condor. That would be pretty cool. But the most important component of all that is realizing that if you let it expire worthless, okay, had you let the original trade expire worthless, you're exposing yourself to a lot of potential risk, which is unnecessary. All right, so let's go back to the original setup, and now I have to get out. All right, and I have to get out of this by doing the opposite, but I don't want to step on strikes because of the PDT rule that I mentioned. Well, notice here that to get out, I'd have to buy a call spread, buy the call vertical using the same strikes, obviously, and the same expiration. And this is what that looks like. All right. So notice that here's the profit zone, here's the loss zone. However, that is the exact same as that. It's the exact same trade. So buying the call vertical at 47.50, 47 double is the same as selling the put vertical at 47 double, 47.50. All right? And the great part of this is you're no longer stepping on strikes because these are puts rather than calls. So you can evade the PDT problem that I mentioned earlier. All right. Now, I did end up doing this because of the account that I was using, and I couldn't get the condor at a price that I wanted, or a butterfly. So I went this route, and I ended up selling this for $4.90. All right. So the trade overall was selling the put vertical to get out for $4.90, and the original purchase was of a call vertical for $1.10. So what happens when I have the following? All right, so that's what I ended up with. Now look at what happens here in terms of price. Let's say that prices close at the end of the day below 47.50. All right, so what happens there is you're going to lose $500 on the put vertical, but remember you sold it for $4.90. All right, and the call vertical expires worthless. However, you sold that for $1.10. So here you lose. This ends up losing $500, but remember we sold it for $4.90, and we sold this for $1.10. So there's $6. So something that expires at $5 that you happen to have sold for $6 leaves you with a profit of $100. And on the other end of the spectrum, it works the same way. If prices close anywhere above 47.55, what happens there? Okay. Well, this goes out for its max loss of $500. And by this, I mean the call vertical. And this is going to expire worthless. The put vertical expires worthless. Let's go through the numbers again. This is a $500 loss, but you sold it for a credit of $110. And this expires worthless, but you sold it for $4.90. And again, $490 plus $110 is $600. And you have to pay $500 to get out here, and that's done automatically. Remember, this is SPX, it's cash settled. So you end up with a profit of $100. Here, if we look at the analysis tab, it's actually, since it's showing prices around 5 or a little bit above, it's going to show our green zone here right now. There we go. Okay, so no matter what happens in this case, if these were the final prices you received, you'd have a small profit, $5, no matter where this goes out. And what ended up happening was, let's see, so here we go. So earlier in the day, this was 4 days ago, so Thursday, yeah. I sold the 50, bought the double for $1.10, so I received a credit of $110. And at, let's see what time this was. Oh, it wasn't as late as I thought, so prices went my way fairly early. Just a minute before 10 a.m., and I guess that's why I probably couldn't get the condor price and butterfly price that I wanted. But anyway, I ended up selling the put vertical at double 50 for $4.90, receiving a total credit for this package of $6. So at that point, I basically, when I did this, I locked in $100, and I didn't have to worry about risk exposure on the original portion, the original half of the trade, which was selling the call vertical. And again, it doesn't sound like a big deal, but really, imagine you had 10 of these on, okay? And it's about to close out worthless in a few hours, and it's trading for 10 cents, but something happens, the market rallies for whatever reason, and then you could be out $3,900 on the 10 lot. You sold this for $1.10. You do it 10 times, your max loss could be $3,900. And that would happen because you didn't want to collect your profit, which was sitting there, and you had max value, pretty much max value on that. So that can be very, very dangerous. And another thing I want to mention too is if you're getting out of this trade and you can set it up so that you have yourself a condor or even a butterfly, then you have not a free look, but if you could do this trade for free or a bit of a credit, yeah, then you set yourself up so that no matter what, you're going to get your profit, but you can also pick up, depending upon how you set this up, a few $100s extra for doing it this way. So it's something to keep in mind when you're getting out of these trades. There are various ways to get out of these trades, and it doesn't matter about the time frame either. You could set it up this way when they're 40 days to expire, 60 days to expire, whatever. 3 days, 2 days, 0 days to expiration. If you get the right price, it's definitely worth considering because of the payoff of a few extra $100 per contract. And at the end of the year, these exits add up to thousands of dollars in your favor, which might be big or small depending upon the size of your account, but it's something to keep in mind. Okay, that's going to be it for this video. Thank you for watching. Good luck today, the rest of the week. Merry Christmas, Happy New Year. Catch you guys later.